Hello and welcome to the speaker series presented by the Entrepreneurs Forum, which is a weekly event featuring industry leaders held every Thursday on Zoom. It's designed for learning and networking. I would like to introduce our sponsor, Mundo Digital Designs, which is a female-led web design and branding agency with a strong social impact focus. Every project with them is a step towards empowerment. For every new client, they sponsor therapy and provide valuable business and design skills to women in need. So that brings us to today's episode of the Financial Canvas with Boris Blum. We're joined with the amazing Rick. I want to welcome both Boris and Rick. So welcome to the show. And Rick, why don't you introduce yourself to us?
Well, my background is my first career was software engineering, software design, and around 2004, 2005, started realizing it was time to get out of that field and transitioned into financial services. Originally licensed as an insurance agent, and in 2007 also received my Series 65, which is an investment advisor license. So I've been working with clients in the area of retirement and retirement planning since 2006 when we started our first company. And nothing is more exciting than making a difference with people. It doesn't matter who I'm with or where I'm at. I have a profound way of elevating pretty much anybody I interact with and leaving them feeling better about themselves. Priceless skill set, especially when we start talking about that. So money is really, really private, and Boris would certainly agree. People are more willing to discuss their bedroom habits before they'll talk about their checkbook. So here we are. We're going to talk about the most intimate, the most intimidating concept on the planet. Boris, let's go.
Well, awesome. I am excited about this amazing conversation we're going to have about finances and money in general. You've got a very unique background and a set of experiences. And I'd like to start the discussion today about getting your take on the investment world, let's say since 2010. I know you've been in the business for some time. You've lived through that whole period. I would describe that period as kind of an anomaly in some ways. Over the long term, we've had relatively low interest rates and inflation. We've got lots of capital access to money due to all of the QE events that we've had. The government printed money in a significant way. So it was kind of an environment of a rising tide raises all ships. And so I'd like to know your take on what is the ramifications of that type of an environment persisting for such a long time, because people do have short memories. And I don't think they remember that much about what happened in 2008 and prior.
My timing in getting in the industry was just amazing, right? Coming in 2007, 2006, and then the carpet gets pulled out from underneath everybody. It's been an interesting ride. And I think what you're pointing to is what will cause the next collapse, so to speak. And the fact that our government has propped up the economy for such a long time, at some point, somebody's going to get to pay that bill, right? How many trillions of dollars are we in debt at this point, Boris? There's that website, is it usdebtclock.org? And
yeah,
that one's going to set some people's heart aflutter, to say the least.
It's an amazing number. I don't know where it's at today, but
34 trillion.
Yeah.
Today.
Amazing.
Yeah. Quite scary, actually.
Yep.
Is that kind of my take on it is at some point, somebody's going to say, somebody's got to pay this thing.
Mm.
Right.
Mm-hmm.
And it
Absolutely.
surprised me. It surprised me that the system allowed for interest rates to go up, because now somebody's got to pay interest on that debt. When the interest rates were super low, that the impact of that debt wasn't so bad.
Well, that's a very interesting point that you bring up, because if we continue on this trajectory, even without increasing our national debt, it is estimated that within the next 12 months, government debt payments are going to exceed, uh, any kind of spending on defense or anything else. So how is that situation going to resolve itself is the question. The government doesn't have any way to generate money other than to tax the citizens. And if they have to spend all their money on interest payments, that is going to be quite a calamity, I think, for people in general and the economy as a whole.
Yes, the economy as a whole, and then what's coming up on the horizon right now is the rapid embracing of AI, artificial intelligence. And I participate in a pretty deep study group about AI. And one of the conversations there was the International Money Fund recently published their opinion about what is the impact of AI going to be on the world economy. And that's an interesting article. It's like 40% of the jobs, no less than 40% of the jobs are going to be impacted, if not even 60% of the jobs.
Mm.
So there's, what is that phrase? The perfect storm, Boris?
Yeah.
Right? Or
yeah, there is no doubt that what you're bringing up is a reality, and I think that at least my personal take on this is that individuals that have a unique skill set, a unique perspective, AI is not likely to replace their abilities. But for people that have a more commoditized skill set, they really need to be thinking about what other alternatives they have to take advantage of, because it will replace a lot of the jobs that are out there. But I think to get back to the financial markets discussion and how AI impacts that, we can look at the markets at least for the last couple of years since ChatGPT came out, and it's just been an astronomical ride, right? The markets have priced in beyond perfection, in my view, that these companies are just going to just be printing money from now till eternity, which doesn't seem to me like a realistic analysis, but that's what the markets have priced in.
yeah, my instinct is that there's going to be this massive flurry for the next 3 to 5 years, and there's going to be this radical consolidation.
Hmm.
So there'll still be a couple of key players on top when all that dust settles, and it's, who is that going to be? Is it going to be OpenAI? Is it going to be Microsoft? Is it going to be Google, Apple? Who's going to come out on top? And that
Yeah.
the impact is real, you know. So I'm a little
What's
hesitant.
interesting to me is, I think what's interesting to me is when this whole AI thing popped up out of nowhere, seemingly, the talk was all about the ramifications of AI taking over the world, and the privacy concerns and all of the things that the negative talk about AI, which seems to have just completely dissipated at this point. And people are just talking about how this is going to be disruptive to either them in a positive or negative way. I look at the companies that are truly benefiting from this, NVIDIA, for example, in terms of their earnings, and they're benefiting it because of the euphoria around AI. They're printing money because they're making chips that these companies want to buy to build these server factories that are being used for AI. But the question is any company actually making money out there using AI? And I'm having a really hard time connecting the dots on that, because I'm not seeing that many companies actually generating revenue with AI. And if uh, we do have some sort of an economic, let's say, outside black swan event type of situation, um, the spigot will turn off almost overnight in terms of buying chips and building server farms. And what is that going to mean for revenue generation? I'm still not clear about the revenue potential for a company like OpenAI or ChatGPT, right? So what the long-term financial implications here are is still quite questionable, but the markets have priced that in a very different way. So there is a lot of irrational exuberance in my mind.
I don't disagree, and what you're describing there sounds awfully like something I lived through called the dot bomb.
Mm-hmm.
It's eyeballs, 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 and damn the torpedoes, and who cares about how much you're hemorrhaging. The study group that I participate in says that some of us have signed up for the $20 a month subscription, and it's costing OpenAI $100 a month to make that available. That's a pretty substantial bleed rate. How do they turn that corner? Or is it like the drug dealer who, you know, $20 is small, and at some point they're going to come back to the reality that they need to charge each one of us $100. Like, some will, some won't, right?
Exactly right. Yeah.
Yeah.
And
So,
I think that those things are quite questionable in terms of going forward. And the markets are a forward pricing mechanism. So if they're wrong, and you happen to be an investor in Mag 7 or Fab 5 or whatever you want to call them, that's been driving this whole upswing in the markets, I think that situation can correct pretty quickly, and people are going to be in a world of pain.
yeah,
So,
no doubt, right?
yeah, so I have a question for you on a tangent on this. And I am sure that you recognize that from, say, 2010 to 2020, there was this unusual period of, you know, call it peace and prosperity, and then low interest rates and all of that. But there was also something that was changing, in my view, during that time. And that is the interest and I guess investors' infatuation with what I call passive investing. They had a hard time when they talked to a lot of advisors looking back and saying, well, what is the value that this relationship has brought to me? And most of the passive funds were outperforming active managers. So their view was, well, why should I pay extra fees to have active management in my portfolio? I'll just ride with the tide, because a rising tide raises all ships, and I will do really well over the long term, and I don't have to think very much. And my advisors just help me with the allocation, and we'll kind of set it and forget it. And I think from 2010 to 2020, maybe that was a reality, and it certainly did work for a lot of people. And advisors, I find, oftentimes are a very skittish group. You know, they see something that's working for them, for their clients, and they're okay, we're just going to go all in this direction. So I think everybody up to 2020 has gone all in on passive investing as a whole. And I want to get your take on that, but I've got some opinions about why I think that might be problematic going forward. But let me see what your thoughts on this are.
Well, what you're pointing to is something also called buy and hold, right? So purchase something and set it and forget it and see how that goes. I'm clear that no single investing strategy makes sense across the board. The classic term diversification. So whether you've got to set it and forget it, or some active investing, or perhaps you're using life insurance products such as annuities to help mitigate your risk and your exposure, that's kind of where I tend to play, is working with my clients to figure out the industry calls it risk tolerance. And I tend to want to understand what is the person who's sitting in front of me, and what is their skill set, their aversion. I have some people who don't want anything in the stock market because of their fear. And what you're asking here is passive investing a good idea? Is that, to paraphrase what you're asking?
Well, not so much whether it's a good idea, because I think clearly for those advocates of passive investing, if you look at what's happened over the last, say, 10 years prior to 2020, it's worked out really well for them. I think if you look at really long time cycles, passive investing probably looks really, really good. But I also say that in the long term, we're all dead too. So the long term is all relative to a person's individual circumstance. And I think as we look beyond 2020 into 2023 now and in the future, I think the world looks quite different than it did before. And the same mechanisms that might have worked over that time frame are, in my view, not likely to persist going forward. But you know, maybe you've got a different take on that.
Well, it's difficult to predict what's really going to go on, right?
Mhm.
I was sitting in Hawaii in 2020 when COVID landed. COVID was being rumored and whatnot and talked about, like it's that thing in China, and then there's the first case in the States, and then I'm literally landing in Hawaii and they're announcing that the Warriors playoff game or whatever was canceled. I'm like, no, they didn't cancel it. They couldn't possibly do that. And it's that kind of event that is more concerning to me. And what you're pointing to is if you are passively invested and that type of black swan event happens, what's going to happen to your portfolio? Are you going to be wiped out? Will it do this is graphic, the dead cat bounce, as it did in 2020? It dropped like a crazy thing overnight and then came back a day or so later. But I don't have the crystal ball to predict how that'll turn out for people. And I think what you're looking for is how does somebody hedge against a full-blown passive portfolio? Is that what you're looking for?
Well, kind of. So let me give you some perspective. From my view, there's a problem that's brewing. And here's the problem. When you have passive management, what you have is people that are assembling portfolios simply based on the weightings within the S&P, for example, right? And so if an investment manager receives funds, they're not in any way thinking about, is this a good investment? Should I put more money into NVIDIA or not? What they're thinking about is, well, I have more money. I have to deploy it. I can't sit it in cash. So I'm just deploying it exactly based on the methodology. In fact, all of these passive management systems are all automated today. There's really no manager actually looking at anything. They're just taking money in, putting it into the market and hoping for the best. Now, when things are going well and it's on its upswing, nobody's going to complain and they just continue to do that methodology. But the problem is that at some point reverses. And that's where you have significant tail risk and the markets, do a bounce. Well, hopefully they do a bounce the way you describe. They could be just taking a significant drop and take years and years to come back to. We don't know. But what we do know that is factual and it's based purely on arithmetic is the fact that these fund flows that are coming into these organizations, and we're talking about billions and billions of dollars in investment capital that is purely being deployed based on no assessment of potential risks to the investor, no assessment of the underlying investment, whether it's a good or bad investment, what the future looks like. It's purely based on where the indexes are going. That to me seems like a fundamental issue that most people don't even recognize exists. And what I think may be the canary in the coal mine, right, is when we get one of these black swan events, which nobody knows when and how, but it will likely appear at some point. Whenever that does occur, we will see people's 401ks become 201ks and maybe even 101ks. Who knows where it will end? Simply because the mathematics of reversing those positions are going to be astronomically expedient with the computer technology we have today and how algorithmic trading works and how everything is fairly automated. Now, active managers are supposed to, not to say that they always do, but they're supposed to be investing in things that they've done valuation studies, the Benjamin Grahams of the world, and they look at things through a fundamentally different lens. And I think that we're in a heyday since at least 2020 going forward, where active management is likely to outperform. At least the better active managers are likely to be able to outperform any of these passive vehicles. The other part to that conversation is the rise of investment capital in the public markets coming from pensions, 401k, all types of tax deferred vehicles, including, by the way, policies, right? Because many of these insurance policies have indexed options and hedging going on, and that's how they protect those positions, right? So all of that increases potential volatility. But volatility doesn't matter until it shows up. And so far, we haven't seen it show up because there has not been this black swan event. But I fear that it will reap its ugly head at some point. And when that volatility does show up, it is going to be something that people are going to respond to in a very absurd way, and likely have to make decisions that will cause them to take losses they wouldn't have ever anticipated.
Mhm.
So.
Yes. So what types of events do you think would cause the black swan? Are you looking at real estate issues?
Oh boy, don't get me started.
Yeah.
I think we've got a multitude of things that could be on the horizon, the least of which might not be the commercial real estate market imploding our banking system. I mean, I think that is certainly a potential problem that we have to be cognizant of. We saw in 2023 with Silicon Valley Bank and what happened there, and the ramifications of that were never felt because the Fed created this BTFP, I think it's called, program, where the banks basically took things off their balance sheets and sent them to the Fed and got 100 cents on the dollar, even though they were worth 70 or 80 cents on the dollar, and got cash for that. Now, that is ending. In fact, it's ending in very near future, this month, I think at the end of this month. And they've announced that they're not going to renew that, which means that these banks have to pay that cash back. Now, I don't know about you, but my feeling is the bank's positions haven't changed much. Those assets haven't really gone up in value significantly enough to offset that. So the banks are going to have to pay 100 cents on the dollar to buy back assets that are really worth 70 cents on the dollar and put them back on their balance sheet. So that is going to be a very interesting event later this month, and we'll see what happens. But the Fed did something very interesting, in my opinion, is they told everybody that this is exactly what they're going to do. At the end of this month, they're going to cancel the program. And you would think banks would be thinking about, okay, well, let's start to wind this down. Let's start to move these positions back onto our balance sheet. And they haven't done any. In fact, they increased their exposure to the maximum that they can. And the program is fully funded as much as possible. And there seems to be no unwinding happening. Now, I know we've got 2 more weeks to go, so we'll see where that ends up. But I think that's a problem. If you look at what happened recently with the bank in New York, I think it's NVCB or something like that, that basically had huge devaluation of the stock value and their problems because they had bought assets from Silicon Valley, or Signature Bank, I think is what they bought the assets from, based on what happened last year. And now they found out that those assets are upside down. And then I think yesterday or today they announced that they have $1 billion investment. And so now everything's supposed to be good. I think the commercial real estate market is a huge problem. I have been involved in that space for many years on the property management side and managing commercial properties, and owned a property management company. And my experience is, what most people don't recognize because they have a 30-year mortgage on their home. If you've got a fixed mortgage at 3%, I mean, you're not thinking about the interest rate. You don't care. That is not the case for commercial mortgages. Commercial mortgages have to reset, and many of them are 5, 7, and 10-year mortgages, and many are coming due, and they're going to reset not at 3% rates, but at 5, 6, 7, 8, and who knows where, depending on the risk exposure. The other part that people don't understand is that when you go with a commercial mortgage to refinance, you have to have a debt service coverage ratio that the bank will accept. So if the property is evaluated now, let's say it was a $100 million building and it's now worth $50 million on paper because you got high vacancies and a lot of these office towers are very empty. We've seen in New York and in San Francisco and other places where these office towers basically are being given back to the bank. The owners are just handing them the keys and saying, all our equity's gone. They're not worth anything. You take the keys. Good luck with it. So the transactions that have happened at very low, valuations. We're talking about an 80% discount in some cases. So if that's what's actually happening in the marketplace, you have to wonder how they're going to refinance this, right? If I've got $100 million building and it's worth 50 million based on its current occupancy, and I go to Bank of America and say, gee, I need a new loan, even if I'm paying my current loan, they're going to say, well, gee, that sounds great. It's only worth 50 million. We'll give you 70% of 50 million. So you've got a loan that's outstanding for 80. Come up with the cash and we'll give you the new loan. I don't know how that math works. I just don't see how that will pan out.
Doesn't seem to make much sense on paper, does it? So
No.
If that doom and gloom scenario happens, which it's quite likely, it feels quite likely to happen, right? Then Bank of America is going to end up owning a whole bunch of, as your example, the banking system will end up owning a whole bunch of commercial real estate that is worth less than the loan that they paid for it with, right?
That's
and
right.
then now we look at Silicon Valley Bank 2.0, right? Another banking system bailout.
Well, that is the question: is it possible to actually bail out the situation by the federal government? So, in my view, I think that there's going to be a massive problem even trying to bail things out. So, what people don't recognize about Silicon Valley Bank is that implosion actually was larger than that, combined with Signature Bank and the others, was larger than the 2008 implosion when we talked about the mortgage banking crisis back then. So the size and scale of what we're talking about is magnitudes larger. And when you've printed trillions of dollars in the last couple of years due to COVID, I think this is going to be an untenable situation. I think it's going to be extremely difficult for the federal government to bail anybody out in that way. So I'm not quite sure. I do see it as a major black swan situation. I just don't see how they resolve it. I don't have the answer to that. I think the other part of that commercial real estate issue in my mind is it doesn't seem to be easily resolvable. If you look at commercial properties, you can't easily rehab an office building and turn it into an apartment building or something of that nature, right? These are very expensive retrofits, even if they're possible. And there's no liquidity for that. So I think that is definitely a potential black swan type of an event that could impact the banking system. But there's an underlying issue that's even worse than that. And if you remember back to 2008, and I think we've forgotten this language of counterparty risk. Nobody talks about counterparty risk anymore for some reason. But the derivatives market is significantly larger than anything to do with the traditional banking finance market. And so if you have commercial mortgages and you're a Bank of America, the assumption by the retail consumer is that those mortgages are being kept on the books and the balance sheet of the bank. But in reality, most of these mortgages are not by Bank of America. They're by regional mid-market banks. They hold the majority of these commercial mortgages, except for some premier properties. And the more important part is they package these up and they sell them on Wall Street. And if anybody remembers CDOs back in the 2008 global financial crisis and what happened there with residential mortgages, well, commercial mortgages are absolutely no different. And there is huge counterparty risk. So these mortgages have been sold and resold multiple times in packaged portfolios. And when you have a bank that takes a property back and there is no more revenue coming in, that is not only problematic for the bank, That's actually problematic for the investors. And now, you don't have the payouts that some of these CDOs and other CMOs put out there. They're going to have a very difficult time staying solvent. And so I think this commercial banking issue probably is number one on my mind. But that's by far not the only problem we've got in the marketplace, for sure.
So that's number one. What would number two be?
Well, so let's talk about employment.
Yes.
I think employment is a big deal. Now, I don't see that valuations in the residential marketplace has changed as much as it did prior to 2008, meaning valuations have significantly gone up, but we don't have the liar loan situations. We don't have the banking issues that we did back in 2008 because it created such a problem. So the loans on the books today are a lot more stable, if that makes sense. But I think the bigger problem here is that people only pay their mortgage as long as they can. And if employment situations change, we have a massive problem in not only the residential marketplace. Now, think about this. The majority of people recently have all been on what we'll call fixed rate mortgages at very low interest rates. So residential real estate hasn't moved very much. There is not much supply in the marketplace. Cost of real estate is extremely high today. Valuations aren't adjusting. There's not a lot of transaction volume. In fact, the transaction volume is historically low right now. And that's because people are locked in at 3%. Why would they move and get a new mortgage and a new property at 6 or 7%? It, makes no sense. So the fact that they're locked in is one part of that equation. And unless something significant happens, people will pay their mortgage before they'll pay anything else, right? Beside food, let's say. But here's the problem. The amount of debt that people are holding on their credit cards is astronomical. It's been going through the roof for the last few years. Interest rates have gone up significantly, which means their credit cost has gone up significantly. So they're paying a lot more interest on that debt. Automobiles over the last few years have gone up in value significantly. People bought those automobiles at inflated prices. Automobiles have never historically been an appreciating asset. They've always been a depreciating asset. And by golly, we found that out in the last 12 months, that they've been depreciating quite a bit. But the fact of the matter is, if you bought a car that's for 20% over sticker or something at the height of the market, and now you're paying a rate that is just astronomical compared to what you'd get for a new car, and you can't afford that, you might consider stop making payments and let the bank take the car back. In fact, that's what's happening in a lot of places. If you look at bank balance sheets that are funding these types of loans, automobile repossessions are going through the roof. So my point back to employment is, as long as people stay employed and they have some cash flow coming in, they will somehow maintain. But the moment they're unable to maintain, this whole thing unwinds. And we've seen massive layoffs in the last 12 months by lots of different companies. Hiring is not great. The Fed seems to be looking at the fact that people are not filing unemployment claims at greater rates, so they're feeling confident about the employment market. But if you look at the numbers underneath the hood, what it shows is that most people are having to have 2 or 3 jobs. And the employment numbers are being held up primarily because people are having multiple jobs, not because they're earning anymore or they're getting better employment. So what worries me is that we have this problem that's brewing underneath. Hiring is not strong. And if we have one little blip with the economy and we continue to have people being off, that is going to completely roll over into their personal finances. They will not be able to maintain their cars or their credit cards or anything else. The wealth gap will continue to expand out, and we will a correction from that. But love to hear your take on it.
Well, that's where, again, on the employment side, definitely AI is going to have some very big impact on that. Um, the concept being there are definitely jobs that could be absolutely simply replaced by using an AI, an artificial intelligence assistant, as an example. Copywriting, and now there's AI tools out there that will mimic an actor's voice. So the whole voiceover industry is being challenged as well. The group that I'm studying AI with points out pretty quickly as a reframe on that. Well, then you, the voiceover expert, you might consider becoming an AI voiceover expert, because again, it's just like my programming days, garbage in, garbage out. You get bad data to analyze, you're going to have a bad result. So same thing with these different things. I've had people tell me that I've used AI and it wasn't so good. Like, well, let me sit down and actually teach you how to use it. And so there's going to be a ripple effect, and that's where the International Monetary Fund definitely is saying there's going to be a very substantial impact on jobs across the planet. And you mentioned layoffs. I'm in Sacramento, California, and we have a very large Amazon distribution center a few miles away, and they were impacted by the layoffs. The layoffs weren't necessarily because of AI, they were because of the robots coming in and taking over the job. And I know might get booed a little bit on this one, but I wait for the day that I can walk into my favorite coffee shop and enter in a kiosk my coffee so that it is made exactly the same way, regardless of which location I go to. Because when I ask for extra hot and I get warm, I accept warm, but I want it extra hot, right? So I'm perhaps the opposite. I'm looking forward to some of that automation coming in. But California is also an interesting place in that somebody in the legislature has brilliant ideas often, and unfortunately some of them get implemented, such as setting up the minimum wage, if you will, for the food service industry. I got no problem with somebody making a good living wage, but one of the restaurant chains, I'm told, is just shutting down. You know, their margins were tiny to begin with, and people aren't so happy about seeing the prices on the menus go up. So what do? Close your doors. What happened to all those jobs? Well, they went out and became unemployed. Or worse, they end up in the homeless camps in Sacramento. Now, go fix that. Talk about another ticking time bomb.
It's to me, being a fellow former Californian, looking at what's going on in California is a whole different podcast segment. It is just absolutely amazing to me what is going on there. But I think, not to digress on that topic, if you look at the employment numbers and you look at the types of jobs that people are getting, most of the jobs have been around low skilled, Starbucks, those types of manual labor, entry level, low pay jobs. Guess what? Those are the jobs that they can't outsource. They can't hire a VA in the Philippines or, a programmer in India, right? They can't do that. Nope. And we have offshored intellectual capital for now a long time. We've had many of these people come to the US, study here, learn their experience, get lots of skills, move back, and are building significant companies and enterprises there. So there is an attack from both sides. There is an attack from the offshore world, where they're providing services, because we're primarily a service-based economy in the US, right? So they're providing services at a much lower cost, competing with us. That is a huge problem going forward, because they will be using AI and they will have access to AI. They already do. just like we do, but they can afford to work on it much cheaper than we can because of their labor rates. So now you have that aspect of it going offshore. And then onshore, the manual skilled labor is being attacked from robots and automated systems and all of these things that are AI driven as well. So for somebody that is looking for a entry level type job that has minimum skills, this is going to be an extremely challenging environment for them to have gainful employment. And I think the numbers bear that out, that what we've seen in the last year or two in terms of hiring. So the question is, what's going to prick the bubble? Like, what is going to cause employment to tank? I think there are many things that could do it. We talked about, commercial real estate is one option. But I think anything that you look at today is a very fickle situation. And it could be a potential problem brewing. We just don't know what the problems are because there's so many potentials out there today. Love to hear what other, potential issues you see on the horizon. I know you've got good experience in the insurance field, right? And if you look at insurance, and part of the issues and concerns I have, when you look at the financial markets, these are liquid markets that, generally money is quite fungible. Wealthy people or upper middle class people that are investing in the markets, who are sophisticated investors, they can move their money around and do different things. But insurance contracts are subject to other constraints within the contract provisions themselves, what you can invest and can invest in. There are some major benefits, obviously, within the insurance contract as well. There are fixed accounts you could put the money into if you're agile and paying attention and you've got good advice. At the same time, you have the other factor, which is, can insurance companies actually sustain themselves in an environment like this? If you recall, back in 2008, we had a small company called AIG that almost imploded, and the government had to bail them out. And you wonder, well, what did that have to do with anything? Like, they didn't invest in real estate mortgages. Well, no, they didn't invest directly into the mortgages, but what they did was they sold insurance on these pools of mortgages, right? Well, that hasn't changed. That continues to this day. The other part that insurance companies are involved in is they're always investing in fixed income type of instruments, right? And that is how they generate revenue, safe and secure revenue to sustain their business model, because insurance contracts are long-term vehicles. That can be quite problematic when you have guaranteed in your insurance contract that you're going to pay out a particular fixed amount. You've got guaranteed insurance costs that are potentially going up or down depending on what the environment looks like for them. And they're not FDIC insured, so they can't expect somebody to bail them out. What they have is the guaranteed insurance fund of the state that they're in, and the hope that, it's not a systemic issue that wipes out the fund overnight, which, I feel a lot more comfortable with the insurance companies and the way they manage their business than I do Wall Street brokerage firms, because they tend to be a lot more conservative in their views. But the exposure that they've had since 2008 and the global financial crisis, and now to the markets in general through these derivative contracts, is, magnitudes higher than ever before. There wasn't such a thing as indexed universal life in any great degree back in 2008, and today it's, commonplace. So all of these things are potential risks, and love to get your take on that.
Well, you mentioned real estate, and I would have to pull reports on individual insurance companies or insurance carriers. My understanding, one of the largest pools of assets they own is real estate for the most part, right? And so they're looking at income producing real estate, which would be commercial real estate. So if
Right.
if they're actually owning it and they need to refinance it, then there's going to be a bubble that they've got as well. So that's one big area. Index products like IUL and fixed indexed annuities and things along those lines, the formula for creating that policy guarantees the insurance company is going to stay solvent. Just the formula. And so I don't have any concerns about that. What you mentioned though is like AIG, when they required a bailout, and so did I think John Hancock and a few others, the bailout that they received was paid back in a fairly timely fashion as well. But it was because of their variable insurance products, not their fixed product line. Their fixed product line was solvent. So for those listening, a variable product is tied to some alternative investment or a mutual fund, something that can actually lose value. In 2004-ish, I had a buddy who had a variable life policy, and he forgot to pay attention to it, and it imploded, and he was mad as hell about it. It's like, that kind of goes to something you mentioned previously as well, is you can't be pissed at your advisor if you didn't do your due diligence either. I guess you could, but that's the world of irresponsibility versus the world of responsibility. So in the world of insurance companies, one of the things that's coming unwound actually is like long-term care insurance. And long-term care insurance, it's great to protect that family and their assets. However, when somebody stops making their premium payment, the pool of people inside of that risk pool shrinks, and then the insurance carrier is financially forced to raise rates for that pool of people, and then again more people cancel. So that's an area state guarantee associations are dealing with. Carriers have actually pulled you. I don't know how long ago you left California, but long-term care insurance companies have pulled out of California for that reason.
For sure.
But, so yeah, I think overwhelmingly IUL and products that are based on the fixed side of the business are going to be just fine, regardless of what black swan happens to occur. It's those with variable life policies or variable universal or variable indexed, variable annuities. Those are the ones that I would be concerned about, especially how is a variable insurance product going to be guaranteeing some sort of payout when they have no cash to back it up?
Interesting perspective. I don't know if I fully agree with it, just from the standpoint that, the general account of the insurance company and the investment portfolios are completely separate animals in that regard. And in a variable policy, the individual investor is really taking the risk on the market valuation change. And so hopefully they have good advisors, people to help them with that. I'm more concerned about the general account being stable, because the investment environment that has persisted since 2010 to now has been quite problematic for insurance companies. A lot of the contracts that they own, let's take a life insurance contract or variable or any annuity, doesn't have to be variable at all, but that has a guaranteed fixed account that they are on the hook for. Those accounts have guarantees that are fairly high, 3-4% guarantees, right? Now, in an environment that we were, where they weren't able to make those kind of investments in government bonds, right? Government bonds are paying, 2% or nothing. They're having to invest and take risks in the commercial real estate market, in other places. So they've stretched themselves for about 10 years in trying to maintain those accounts. But those guarantees are contractual. They're not going away. Now, in an environment going forward, yes, their future revenues might be different, but the investments that they've made in those commercial mortgages are subject to, the whims of the market. And if we do get a financial collapse, and a lot of these companies have significant commercial real estate exposure, that could impact their guaranteed accounts based on their profitability. The other factor is that when the economy goes down, unfortunately, people do cancel their insurance policies. They can't maintain them. So the level of revenue for insurance companies goes down as well, even though the risk is going down. So I think there's a variety of factors at play here. I don't know that anybody has a distinct answer. And I think the gist of this whole conversation is there are lots of things to worry about in an unpredictable, uncertain time that we live in today. And so having exposure to the financial markets without a deep understanding of what the risks involved that somebody has in their portfolio, I think is not a good recipe for success. I think individuals need to not abdicate their responsibility to advisors. They need to take responsibility themselves, understand what risks they are taking and what they're invested in, and make sure that they are prepared for potential drawdowns. Make sure that they are agile in their approach if something is to change, because it could change at a moment's notice, and be nimble enough to not buy into the mantra that, oh, it will all be okay. Because yes, in the long term, it might be okay. But if you're an individual that's approaching retirement in the next 5 to 10 years, you don't have that time for it to be okay in 20 years. It's got to be okay relatively quickly, because that is your nest egg. So I think a lot of people have to have that heart-to-heart conversation with themselves about what is appropriate risks that they should be taking in an environment like this. But I'm sure that that is similar to the counsel that you give to your clients as well.
Absolutely. When we're getting closer to retirement, it's time to start taking cards off the table, so to speak, looking at some products with guarantees, such as fixed annuities or fixed index annuities with income riders. The whole point for saving that money for your lifetime has been to produce some form of income. And so income-based products like an index annuity could be a perfect fit for some people. I'm sure you've met advisors where they're one trick pony, and I will find a way to fit your foot into that shoe. It's like, no, please don't do that.
Yeah.
Find out, is this person a captive advisor? They only work with one company, one product. Not likely it's the best fit for you across everything you need to accomplish. I get real soapboxy on that. My wife, if she was here, she'd start like nudging me, because I'm get a little edgy around captive agents and what they can and can't accomplish, and the fiduciary standard versus the suitability standard. And so there's just everybody who's listening, be aware that
that's almost standards. A whole separate topic
it's a
for a podcast
topic.
I think.
Huge topic. I get
for sure. Well,
yeah, I'm proud to be a fiduciary.
I was just going to say, I see a message from Erica. You probably should open it up for questions from people in the audience if they have any, because we're running close on time.
Sure.
So I think that's something we should do. Let's see. Is there anybody that has a question, a comment, anything they'd like to add to the conversation? Okay.
All good.
I guess
not. Must have gone over everything very well then.
I guess so. I guess we covered everything. Well, I think in closing, Rick, I think what's important to mention is we are living in, I think, in very uncertain but unusual and exciting times. They will bring unique opportunities for everybody, but they will also bring unique risks. And it's important that people think about those things and address them correctly. I see a question here. Given to the necessity, what are the 3 specific recommendations? Well, I'll let Rick, if you want to chime in on that as well. I will, kind of give you my 3 recommendations. I think the first thing that you need to do is take a look at what risk exposure you have in your portfolio. Whether you are managing your own investments or you have an advisor, irregardless, you should do a check and say, what are the potential drawdowns that I could experience if things are not going well? There are lots of alternatives out there in the marketplace to secure your portfolio or to hedge some positions if depending on the size of the portfolio. So I think those are important factors to consider. I would also consider, do you have an emergency fund? I find that most people are lacking in liquidity and they have to get out of their investments at the most inopportune times because they have not put money aside for those emergency situations, which invariably do show up in our lives. So I think that is a potential as well. I think lastly, I would recommend not getting caught up in the hype. I see a question about crypto, so that makes me think about that as another issue out there. It's not that I believe crypto doesn't necessarily have a place, but it's not a investment. It is a speculation in my mind. And so I think people need to take it for what it is, be very limited in terms of their exposure, because the volatility can be absolutely extreme. Although it's done well in recent months, it also has done extremely poorly during the pandemic. If people had experienced that, they know what that feels like. Very unpleasant. So those are probably three things that I would think about is differentiate between speculation and investment, and the other things I mentioned. But Rick, you want to chime in on this? You have any opinions?
Yeah, a couple of things come to mind. Yeah, you need to understand who are you working with, and as Boris is pointing out, what is the risk tolerance? What is the maximum drawdown of your current configuration, and being okay with that. And there's a lot of factors that need to be tied into that. So that nothing we're saying, Boris or myself, is personalized to you, the person, even though you, a person, typed in this question. There's no way we could personalize anything for anybody. Right. With regard to AI, I've created something, an assistant that I've put up on my website. It's an AI assistant on my training.loek.com. So that's training.loek.com. And it's basically, that allows for a very tailored conversation based on what dialogue you interact with the chat program about. Another good thing to consider are the fixed products from an insurance licensed person, somebody licensed in your state. Look at those and understand how they work. There's people that frame them as, well, you're buying your own pension and things along those lines. But they definitely provide guarantees that you can't get anywhere else, in the comma, subject to the claims paying ability of the insurance carrier. I mean, all the classic protect yourself questions need to be asked of whoever you interact with. And is this person that you're working with somebody that you trust? And Boris, you probably heard this phrase as well. Are you confident enough in your current situation to seek a second opinion? Because out of a second opinion, there's three possible options. Yay, congratulations, you're doing everything perfectly. B, there's maybe a couple of little adjustments. C, we really need to sit down and have a heart-to-heart conversation. So yeah, seek a second opinion from somebody who's not giving you the first opinion.
That is wonderful advice, and Rick, I appreciate that. And in closing, I'll just mention that I am working on a new project. I'm hoping to have it launched soon. It is going to be called the Wealth Council. It is a mastermind program for people that are aspiring to achieve financial independence. And it will allow individuals to go through a process, irregardless of whether they manage their own investments, whether they work with an advisor. It doesn't really matter. A completely unbiased approach to helping them make these types of decisions. and what's appropriate for them. There is no obviously independent investment advice or anything being provided for individuals in the program. It is purely an educational program to help people make these prudent decisions. I will leave it at that. And Erica, I think we're done for today. We're out of time. So I really appreciate everybody showing up. I think this was a great conversation. I thoroughly enjoyed it. Rick, you are truly amazing. So thank you for being here. And Erica, I'll turn it back to you.
All right. Well, thank you, Boris, and thank you, Rick, for being on Boris's podcast. We enjoyed having you.